go ahead and get started. So the topic of today's presentation is fractional life settlement investments. It's a pretty interesting topic for many of you. We had a great interest. We had many sign-ups for this great interest, and we're going to be having a guest presenter joining us to basically provide the information. And what I'm going to do is just do a brief introduction here. Just a little bit about myself. I'm a founder and president of Sense Financial Services, and what we do is we help our clients take control over their retirement accounts. I'm also a licensed California insurance agent, and this opportunity, I've been researching this for quite some time, and it is a great option. I think you will see why. But just a quick disclaimer, Sense Financial Services is not a fiduciary, and we do not provide legal, tax, investment, or accounting advice, and we recommend that you speak with a professional if you need an advice like that. But just start with this slide for you guys about what does it mean to have a true diversification. And basically, if you have your money invested in a stock market, whether it's a retirement account or just personal savings, my daughter, I think, did a great illustration on this cartoon, a man holding a basket of which the bottom fell off and all the eggs now broken, and that basket represents a stock market. And wife saying, I thought that our investments were diversified. Well, if you are only invested in a stock market, then you don't have a true diversification. You might be diversified across different stocks and different mutual funds, but it's still in the same asset class. So in order to achieve a true diversification, you need to put your eggs in different baskets, and what we're going to be talking about today represents one of those baskets, which is not tied to the stock market. It's not tied to the real estate market or any other market for that matter. And Brian will do a good job, I'm sure, to demonstrate that. And in Ecclesiastes 11:2, it says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. And this is true. We don't have control over tomorrow. And to protect ourselves and our assets from unknown, it's very wise to spread the risk. And since our specialty is self-directed retirement account, although this opportunity is available not only for the retirement accounts, but many of the clients can use the retirement accounts to invest in this kind of opportunity. But let me just spend a minute explaining basically the difference between a conventional retirement account and self-directed retirement account. With the conventional retirement accounts, you have an IRA or 401k, and your investment choices are controlled by the custodian, and those choices are limited to stocks, bonds, and mutual funds. That's pretty much all you can do with your retirement account. But with self-directed 401k, your investment options are much broader. Now here you'll see an example of just potential investment choices if you have a conventional 401k. And I remember when I had a 401k at a company that I used to work for years ago, a representative from the company will come up and meet with us once in a while and give us a similar sheet like this. Those were investment choices available with our 401k, and they were very, very limited. But if you have a self-directed IRA or 401k, your investment choices are virtually limitless. So on the right-hand side, you'll see what some of the most common investment choices are available with self-directed IRA or solo 401k. You can invest in real estate, you can invest in tax liens, tax deeds, so forth and so on, including life settlement, which is going to be a topic of today's presentation. So again, if you want to minimize your risk, if you want to diversify, this is just one of the options that is available for you. And with this, I'm going to go ahead and give the control over the screen to Brian.
My name is Brian Clark, and I am the Director of Business Development for Reliant Life Shares. And as you'll see here on this slide, our slogan is institutional profitability brought to the individual investor. We're going to talk about an investment or an asset class today that has been used by large institutional investors like Warren Buffett, Deutsche Bank, Credit Suisse, AIG, Wells Fargo, really so many of the big companies, Blackstone, I mean, I could go on. They pretty much all use this asset class and have for quite some time, for decades, because it's one of the best ways to get good returns and a way to hedge out market risk that Dimitri was just talking about. So a little bit about us before we dive in. We're based in Sherman Oaks, and we're an industry leader in fractional life settlements, and we'll get into exactly what that means. Our executive team have over 100 years combined experience in the life settlement industry, both in the U.S. and internationally. This has actually been an asset class that's been used more internationally by individuals than domestically. We feel we definitely distinguish ourselves by really embracing the disclosures and the regulatory requirements, and we really set the pace as far as the level of transparency and disclosure that we provide our investors, and you'll see that as we get into it. We only work with properly licensed and regulated sales agents, and of course, as Dimitri mentioned, as a California Life licensed agent, he is one. So we're going to touch on the goal and the problem. Dimitri touched on that a little bit. We're going to talk about what it means to truly be diversified. A lot of people think they're diversified. A lot of people thought that the real estate holdings back in 08 and 09 might have helped them diversify. And, and at times it can, but what you really want is to uncouple with your alternative investments to deliver good returns, but low correlation. And that's the idea behind using an investment like this. We'll take questions at the end after we tell you about how it all works. So the goal, right, everyone can agree, is getting to and through retirement as smoothly and as securely as possible. I mean, even the way this year has started, it's been a pretty wild ride in the stock market. And no question, the last 15, 16 years, we've seen our fair share of roller coaster activity in the markets. Sometimes it does feel like 2 steps forward, 1 step back. The idea is to grow your wealth. An advisor I used to work with, he said his job once, which I really liked, was to make sure you only had to get rich once. So if you can grow it and then don't lose it, that's the idea. Dimitri, still able to see and hear me okay?
Yes.
Excellent. The problem is, what do you invest in and how do you go about investing? And that's the big mystery. A lot of people have a lot of advice and a lot of opinions. We feel we have an excellent solution that you can add to the mix, which will help you alleviate some of the volatility that you'll typically see, but without sacrificing return potential. Historically, bonds have been added to portfolios to take care of some of the stock market risk, but we have been in such a low interest rate environment that they really haven't paid very well. And if rates rise, well, a lot of people's bond funds may give them, a surprise on the negative side. And so if you can add something that will hedge out the risk, but that will still give you a chance at a good return, and I'm talking double-digit type returns with a windfall potential, that's the idea. So we all remember, we won't revisit it too long, but the S&P really had lost more than half its value off its peak back in the festivities of 09. And like I said, we won't dwell on it. We've bounced back awfully nicely from it. Some people think maybe we've come too far too fast and there's still another shoe to drop. Only time will tell. All you can do is navigate and diversify as best you can and stay the course. This is an interesting look at the Dow, going back over many decades. And don't worry about the print. It's probably pretty small for you to see, but I just want you to focus on the gray bands and the purple bands of time. The market can spend a decade or more, maybe 2 decades or longer, treading water where you don't get anywhere. And then at other times it goes on, a serious run. And you can look back and see the period from 2000 to 2011, pretty much. Really, you didn't make much ground. Nearly 11 years, and you made a whopping cumulative 0.7%. Before that, though, the heady 80s and 90s did great. But before that, a lot of people remember the 60s and 70s, 17 years really with basically no gains. And this pattern is repeated. And so the point is, if one of these periods of treading water occurs either just before or just after you retire, it certainly can set you back and may change your lifestyle in a way that is not what you're looking for. So diversification can help this, but are you diversified? Most people own stocks, bonds, real estate, and some alternative investments, right? An example of alternatives are other things that are supposed to be non-correlated. A lot of times people will pick up a precious metals holding. Well, gold and silver, the last handful of years have also not been a great place to be. People have lost, half of their value in some cases or more, especially with silver. And so, again, it's just a matter of being truly diversified and getting from your alternative that what you're seeking, which is good returns without the stock market ride. So correlation matters. You want your alternatives to act as a hedge to your primary holdings. And you want to seek uncorrelated alternatives that don't give up that upside potential. So that gets us to life settlements. What the heck is a life settlement is a question I hear along a lot of the days that I work. And that is, the answer is very simple. Life settlement is simply the term that is used for the sale of a life insurance policy. Most people don't even think of or realize, which is why the big players, the large institutional investors, have pretty much had this to themselves. Most people don't even know that you could invest in someone else's life insurance policy. They don't even know that if you had a life insurance policy that you could sell it. And a life settlement is simply that transaction of selling a life insurance policy. What our firm does is we acquire these policies typically off the secondary market once they've already been sold by seniors with usually health impairments, and we open up the investment in those policies. And what the difference between the cost of acquisition and the premiums that you have to pay on the life insurance policy, the difference between that amount and the death benefit is the opportunity. And this all hinges off of the arbitrage, essentially, primarily between how healthy the person was when they got issued the insurance policy and were told what their premiums would be, and any health changes that occur as they age, and that where maybe their life expectancy is not what they originally thought it would be at the time of issue of the life insurance policy. So if we give you a way to participate in investing in these life insurance policies, you know that your payout is coming from some of the strongest, largest companies in the world. And a life insurance death benefit in the United States has never not been paid off. And so it's a pretty solid, stable place to get your payout when it happens. And it's a long-term growth play for you. But the returns on average can be very much double digits, 10, 12% a year is what it will average out to in a lot of cases. And we'll talk a little bit about how we can demonstrate that to you. So the evolution of life settlements, believe it or not, goes all the way back to 1911. There was a Supreme Court ruling in 1911 whereby the Supreme Court, Justice Oliver Wendell Holmes, ruled that yes, a life insurance policy is an asset and it's yours to sell and do with what you will. Now, a lot of people confuse what we're doing if you go to the 1980s with what were known as viatical settlements. That conjures up a lot of thoughts for those that are familiar with it. With the HIV and AIDS scare, a lot of people sold their policies that were diagnosed with HIV or AIDS. They needed money for the experimental treatments, and the only asset they had left in some cases to buy the care was to sell their policy. Well, that didn't work out so good. What you had in the industry, looking at it from an investment perspective, was concentration of risk, right? Everybody had the same, that was doing this, had the same health impairment. They all had HIV or AIDS. And fortunately, for the world, really, we found drug treatments that, extended people's lives. But unfortunately for the investors that purchased these policies, So that is, I want to differentiate. That is not what we're talking about. We're not purchasing policies of terminally ill people. We are, you could call it, instead of a viatical settlement, what we're doing is senior life settlements. So that's an important distinction. In 1995, the industry had grown enough. And by the way, Buffett has been in it all the way back since the 80s, Warren Buffett. And if you're familiar with him as one of the greatest investors of all time, he recognized the opportunity here when he examined this industry. There was a life settlement association, life insurance settlement association created in 1995 known as LISA. Our CEO, Andrew Murphy, actually helped establish LISA's European sister named ELSA, which is the European Life Settlement Association. And so that's the kind of talent and experience we have at our firm in this asset class. So the last 10 to 15 years, I just got a note that someone can't hear me. Is the audio still okay?
I can hear you okay. Perhaps.
Okay. Well, I'll try and speak up if it's just a volume issue. Okay.
Yeah.
Thank you. Anyway, the industry has grown to 10 and then $15 billion. And in California, there was unique legislation passed, and I'm going to skip ahead here, to a Senate bill that was passed in the early 2000s here in California that essentially allowed for individual investors to take part in this. But Business Week all the way back in 2007, early investors were hedge funds such as Cheyenne Capital, DB Swern, Dune, New Stream, Reservoir, XE. I mean, really Goldman Sachs, Credit Suisse. You're going to know a lot of the players that have been using this. But now, our slogan, bringing institutional profitability to individual investors, that's the idea, thanks to some legislation unique to California that allows for qualified California investors to participate in this asset class. Here's another New York Times article back from 2006, also referencing some of the big players, Credit Suisse, Deutsche Bank, Warren Buffett. They have invested hundreds of millions and in some cases billions of dollars in this space. This is why they are doing it. If you look at like the period from 07 to 09, the purple bar represents the S&P. And what the idea is, when the market is going down, you'll see that life settlements are pretty steady. There'll be some fluctuation, based on the risks associated with the asset class, but really they're disconnected and unplugged from the S&P. And that's the idea, is if you can add this to your portfolio without having the stock market risk, that's the idea. So let's talk about the elephant in the room for a second. Most people say, wait a minute, I'm going to invest and wait for someone to pass away to see a benefit. Well, let's look at a Wharton Business School study. They looked at almost 1,600 policies, and they found that people that own these policies, if they cashed them in, they would get $93.4 million. If, however, they settled or sold into the secondary market, they could enjoy a 360% value increase to their portfolio. So what does that mean? That means if a senior has, for example, $1 million policy, maybe it has a $50,000 cash value, they have a few options. And that is, they can either cash it in for the $50,000 or they can let the policy lapse. Well, if they let it lapse, they essentially have nothing. If they cash it in, they get $50,000. But if they do what's called a life settlement, they could enjoy perhaps $200,000 instead. So seniors that sell their policy are greatly benefited, and that's key to understanding the policy, the life settlement industry. Now, what does this mean for you, the investor, as far as the potential returns? There was a 2013 study done by the London Business School. They looked at over 9,000 policies representing more than $24 billion of death benefit, and they looked at it for more than a decade. They found that the expected annual rate of returns would be, and it's a simple interest expressed here, 11 to nearly 19%, with an average of 12.5%. Now, I don't know about you, but if I could enjoy no volatility related to the stock market, plug this into my portfolio, maybe for a 5 or 10% slice of my portfolio, and enjoy the potential of getting this kind of return, now you understand why the big players are using this asset class. So it's originally designed for institutional investors, but now you can participate here in California through Reliant Life Shares, thanks to Senate Bill 1837. And that's what defines everything that we have to do as an offering company, as far as taking care of you, the investor. And there's a couple key things that I want to touch on that you should be aware of. What we're doing is we're offering you the opportunity to access the same asset class as the large institutional investors. We allow you to grow and protect the money while eliminating the risks of the stock market. We look, boy, it looks like some people are having a bad connection, Dimitri. I don't know if there's an audio problem or not.
You can go ahead. It looks like everybody else is fine, but
Okay.
perhaps.
All right. Yeah, maybe it's there on their end.
Yeah.
So what we do is we take the policies that we acquire and we place them into a third-party trust. We use UMB Bank as our trustee. And that way, you know, you're not putting your money with Reliant. Your money is invested in what you're getting is a beneficial interest in a certificate of ownership in the trust that owns the policy at the third-party trustee. That's an important step. And we'll touch on that here in a minute. The other important element to the life settlement business and where the primary risks are coming from are the life expectancies, right? When a senior sells their policy to get a life expectancy, and then what we do is we get multiple life expectancies from multiple firms, and that's where the rubber meets the road, because the life expectancy and the longevity risk is primarily the risk associated with this. So the way Reliant does the business is we are disclosing multiple life expectancies from multiple professional third-party providers. That's a key differentiator. Not every player in this space has used outside third-party life expectancy companies. Definitely, this is so key, right? Because you may read about a company out of Texas that they were utilizing an in-house doctor to come up with their life expectancies. Well, that's not how we do it. We use the same life expectancy providers that the big institutions have used for multiple decades. What we're trying to do here is mitigate the primary risk, which is longevity risk. The use of the third-party trustee is another key element that differentiates Reliant. You want to use a third party so that, again, you're not writing your check to Reliant. It's going into the subscription escrow account as the escrow agent. Then UMB Bank is responsible for dispersing your returns back to you when policies mature. They're responsible for collecting and paying any premiums that are due. And by the way, you won't have any premiums that are due on any of your investments unless the insured outlives their life expectancy. And that's, again, where the risk comes from. But we disclose all of that up front, lets you see more information than you may care to as far as what the insured looks like. But, UMB is a large, you're welcome to Google them, publicly traded under UMBF out of Kansas City. And they've been named by Forbes as one of the best banks in the country. So how would this work if you said, you know what, this makes some sense to me? You can choose to purchase a fractional interest in the various policies that we have in inventory. And if you do that, what you'll see is we take in your subscription documents and the money goes into escrow at UMB. Then the funds are applied to the individual policies that you selected, and a portion of the funds are carved off and set aside to pay premiums up to and through the premium escrowed through date, which pretty much lines up exactly with the life expectancy that we're using and disclosing to you. The investor funds are then held, and UMB holds the title to the policy until maturity, in which case the death benefit UMB into the trust, and UMB is responsible for dispersing out to you as the third-party trustee your returns. This is going to separate us and provide you all the information ahead of time so you know exactly what you're investing in. We provide a ton of information. You'll know the policy number, you'll know the carrier, you'll know all the ins and outs, what the premiums are, and we can project based on what your portion of the policy is. And this is where the word fractional comes into play. Sometimes people say, wait a minute, so life settlement, I get it, but what's a fractional life settlement? Instead of needing millions of dollars to invest in this asset class, you can invest with a relatively small amount of money. The minimum investment is $20,000. And that would allow you to purchase into this asset class, and you can choose to buy multiple policies. By doing so, you're giving yourself diversification among this asset class, which you're using to diversify. So we show you all this ahead of time. This is just an example. This person is age 82. Their life expectancy is 63 months. It's a male. There's another life expectancy that we disclose of 57 months. And we lay all this out. What we then do is separate and hold the premiums payable up to the 60-month life expectancy in this case. And based on the initial investment, the total return in this example, which is a very real example, is a 100% total fixed return. So your $50,000 would turn into $100,000. What you just don't know is when. So whenever the policy matures, it could be next year, it could be 2 years, in which case, you double your money pretty quickly, maybe get a 50% annual rate of return. That's possible. So there is that windfall potential. If it goes to life expectancy, you would enjoy, in this example, a 5-year life expectancy would be a 20% annual rate of return. If it goes long, that's where the risks are associated. So you would have to contribute additional premiums, but that doesn't mean that the investment isn't going to still perform very well for you and be very competitive. You could have a life expectancy be exceeded by a year or 2 or 3 and still get a solid single-digit return, which I would argue in this environment is still very competitive. So the asset class can provide good upside potential, and even when the investment doesn't go quite as well as you'd hoped, the odds of you getting a solid single-digit return are still quite high. So the other primary risk, so that's what we call longevity risk to the investment. The other risk would be liquidity risk. Think of it as, you're in it until the policies mature. Now, if you invest in a handful of policies and they have a spectrum of life expectancies ranging from 3 to 8 years, you could enjoy a maturity perhaps in 3 years, and then maybe another one in 4th year, 5th year. You can choose to reinvest at that point or use the funds and reinvest them somewhere else. But liquidity risk is important. Some other risks which aren't as likely, but they are there. The insurance company, I can't tell you that an insurance company won't never not pay out on a death claim. I can just tell you that that's very unlikely, and it's one of the strongest industries out there. I would say that for a multi-trillion-dollar industry, they all run to each other's benefit if any of them ever get into trouble, and that's going to help mitigate that risk. And certainly, as each policy matures, you could have some tax issue, but certainly Sense Financial can help out with that with Roth Solo 401k or Roth IRA self-directed with checkbook control. That's the idea of perhaps holding this asset in those types of plans. So just in summary, we are talking about a non-correlated passive investment with good return potential, modest risk profile, and it's going to act as a hedge against interest rate risk, stock market risk, real estate risk, every other risk that you can pretty much come up with. So the idea is, depending on what your portfolio pie looks like, figure out if maybe a 10% slice might make sense for this asset class and slip in life shares into your portfolio. With that, I'm going to turn it back over to Dimitri, and we'll take some Q&A.
Thanks, Brian. First question that we have is, do you have to be an accredited investor in order to invest in life settlement?
No, you do not. Certainly, if you are an accredited investor, you certainly do qualify. The legislation that was passed that I mentioned, Senate Bill 1837, they laid out that you have to be a qualified investor. And what that means is you have to have $250,000 of net worth, excluding the value of your home, home furnishings, and automobiles. Um, so basically, as long as you meet that 250 requirement, you could participate. But certainly, if you are an accredited investor, then there's no problem at all. The other thing is that the legislation laid out related to this is you are limited to 10% of that net worth unless you are an accredited investor, and then you do not have, that limit.
Gotcha. Okay, that's good to know. Now, can you talk more about the minimum amount investment? Talk about
Sure.
that and diversification.
Yeah. Our investment minimum is $20,000, $10,000 per policy. So if you had $20,000 you wanted to invest, you could get a piece of two different policies. We feel that the more policies you can get a hold of, the better. So, if a person is worth, based on the criteria I laid out, let's say $500,000 or $500,000, and they think a 10% slice makes sense, they could invest $50,000, and that way they could get a portion of 5 different policies. And so obviously that would add more diversification and, would be better.
Okay, thanks. Question from Summer. Can you put 100% of your portfolio into this?
Well, again, if you're accredited, nothing would stop you except common sense. I would not, just like I wouldn't put 100% of my portfolio in the stock market or any market. I don't think you want to be 100% in one investment. The idea is to have good diversification, and so if you're a qualified investor, you are limited to 10%. If you're accredited, there's no limit, but I think, when you start talking more than 20, 25% of your portfolio, liquidity risk certainly should become a key concern.
Gotcha. Yeah, that's a good answer, and I want to get back to the very beginning of the presentation that we are offering this as a way for you to diversify your portfolio to spread the risk. And so if you take entire portfolio and invest it in life shares, then it's a good investment, but then it will not be prudent because you will not be diversified then. Question from Sam, is this only available to California residents?
Yes, because we are operating under legislation that was enacted based on that California legislation. We do, currently work with California qualified investors.
Okay, great. Really good question from Rob. What is the fee structure and when are the fees assessed as far as the entrance and exit?
Well, for the investment itself, there are actually no fees. Everything is built into the rate of return that you'll see offered for each policy. Certainly, if you have any sort of qualified plan and, self-directed custodian, that's something, Dimitri, you could help answer from your end, depending on what kind of plan it is, and I'm sure that's going to vary. But the nice thing about this is everything's kind of known up front, except for two things. When is the maturity going to happen? And basically tied with that is how long would I potentially have to pay additional premiums if the insured outlives the life expectancy? So if the insured passes either at or before the life expectancy, then everything was known ahead of time at the time of investment. So if you put in $10,000 and it was a 100% total fixed return, if it happened in within 6 years, let's say the life expectancy was 6 years, and we currently have a policy that looks just like that, your $10,000 would turn to $20,000. End of story. Anytime before the 6 years was up. It's only in the event of a long maturity that you would have any potential modification to the annual rate of return and the total fixed return. But that's something that we certainly can get into as you look at the various policies we have for inventory.
Jeff asking if there's any recommendation for a company that is similar to Reliant that would offer this to other states or in other states to
You
investors.
know, I don't know of anyone else that is offering it quite the way we do. I believe there's a company out there, but I don't know what states they can and cannot. But I'm sure, you know, with some internet research, you could find out other players. But because we only do business in California, that's certainly been you know, where our focus is.
Gotcha. What's the possibility of you offering this to investors in other states in the future?
It is a possibility down the road. You know, if we end up working out like what would be a Reg D offering, you know, that's conceivable, but you know, no timetable for that at this time.
Thanks. William is asking on your chart, comparing it to the S&P and the stock market, it ended at 2009. What has happened since 2009 and why your chart uh, uh, did not show it that time frame?
Well, the purpose of that chart was simply just to zoom in and look at how life settlements performed when the stock market wasn't doing well. And there's no question that the market, you know, rebounded nicely. Life settlements have continued to perform. They're pretty consistent across the board without a lot of variation. And so if you project that out, certainly the stock market, you know, would catch up. Whether or not, you know, it would, depending on what you consider as a start date. Um, you know, in the long run, what is the market average? You know, high single, low double digit type returns. It's just a rocky ride along the way. And so over any decade or two, that's where I think, you know, the addition of our asset class can really shine.
I see. Thanks. Can you talk a little bit more about using qualified funds versus non-qualified funds for investing in this vehicle?
Sure. While we don't give tax advice, what it really comes down to would be, you know, taxation. I mean, because this is an illiquid investment until the maturities happen, you know, sometimes if you're younger, qualified money can make some sense. Certainly keep in mind any RMDs that you would have to take out as you approach 70 and a half. That can be a factor. And so again, that goes to not tying up too much money in an illiquid investment based on your liquidity needs. And if that's being driven because you're holding this, you know, in an IRA, for example, that, you know, that's a consideration. But I would say the advantage of using IRA money, for example, would be when a policy matures, your money, you know, is coming out of this investment if you choose not to reinvest, but back into your IRA. So no taxes are due at that time. You know, you pay taxes at the end. Whereas if you see a maturity along the way, then you would see taxes in the year that you do have the maturity. And, you know, these are typically not given long-term capital gains treatment. And so, again, that's something that folks can check with their tax advisors on.
Thanks, Brian. Janessa is asking how much of the premiums, if the life expectancies are extended, can you provide an average amount?
Sure. Basically, if you look, and we provide all this information, let's see if we can do this. I don't know if you'll end up being able to see it, but I'll just show you an example of what we're looking at here. So here's a current policy, and you'll have to let me know, Dimitri, if we didn't test this, if this comes through and can be seen.
Yeah, we cannot see it, but just, you know, throw some numbers there just to give an
Yeah,
idea.
okay.
Talk about details with individual
Sure, if you
people.
can't see that, yeah, definitely. Basically, there'll be a percentage, and like the one I'm looking at, it was almost a 6-year life expectancy. Your rate of return, if you'd gotten into it at the beginning, would be 20% a year at the target life expectancy, 17.15 exactly. And if you look out, let's say you go out 3 years long. So instead of a 6-year life expectancy, you have a 9-year life expectancy. at that point, your annual rate of return would have gone from 17.15 down to 5.38. So that's a 50% longer time than the life expectancy, right? 9 years is 3 years longer than 6 years. So that's 50% long, and you still are getting approximately a 5.4% rate of return. So you have to get out about double the life expectancy before you would have any sort of principal risk, is a pretty typical average answer. But every policy, we disclose all of this on a year-by-year basis ahead of time. So you can see the projections based on the premiums, and you'll know what your share is based on how much you're investing.
I see. Now, what is there some a risk to an investor? Do they have to come up with any out-of-pocket funds to support this? If somebody invested and let's say there is a longer life expectancy, or somebody lives longer.
Well, yes, that is where the risk comes from in the investment. Without that, there really wouldn't be any risk to the investment, primary anyway, other than liquidity and some of the others we covered. But the longevity risk and having to potentially pay premiums in the event of a long maturity, that is where the risk comes from. But if you buy multiple policies and you get one or two that go long, and maybe instead of a 12 or a 15% return on per year on that investment, maybe you get one that goes short and you get a 30% return. I mean, that's kind of how it works out. So again, as you saw in the London Business School study, somewhere between 11 and 19% is what they expect. I wouldn't make any projections, but you have to start realizing that if you buy multiple policies, what are the odds that all of them are going to go, long in the first place, let alone so long that, you could end up having to come out of pocket net on your overall total investment. Does that make sense, Dimitri?
Yes, yeah, and you're talking about here in those life expectancies. Basically, you provide all this information to investors before they make that investment decision, correct?
Correct, and that's for every single policy. You're going to get all the information on the policy, of course, minus the insured's name and information. You're going to get a year-by-year projection of what the premiums due would be. You're going to get the full life expectancy report from that third-party life expectancy provider. You're going to see, height, weight, age, sex, all the health conditions that have been disclosed. And so that's really, a lot of information that is available. And some of the premium questions that we're getting, I think, are answered on the sheets that you would see. And I think we can send out some samples of that as a follow up to this as you talk with people.
Okay, you said that you basically locate these policies that already been sold on the secondary marketplace, correct?
Correct.
And what's the criteria that you're using to acquire those policies?
It's really a very complicated answer, but I will just say, if you think it through, the people can't be too young or too healthy. They can't be too old or too sick. The premium to face ratio has to be just right. The carrier has to be just right. The policy has to be just right. We're talking about universal life policies here. Other types of insurance don't typically make a good investment into this. And so there's a very narrow window. And so once in a while, we'll get questions where someone will say, oh, my neighbor might want to sell their policy. Well, they might have some value. And, we certainly will try and, help someone out with information. But the odds of that particular policy fitting all the stringent criteria that we need to see that's going to make it a good investment for our investors, that's the question, right? And, an example I would use when people say, well, gee, if a person is very old or very unhealthy, why is that a bad thing? Well, it means that we'd have to pay way too much, or they wouldn't settle for any reasonable value. So if you knew you had 6 months to live and you had $1 million policy, you wouldn't let it go for something less than, $950,000, $990,000, right? I mean, that's the idea. And certainly if someone's 30 years old and healthy as a horse and wants to sell their policy, well, we know we're going to have to pay premiums probably way too long. So you can see kind of some of the elements that go into what we look at.
I see. Can you maybe just give an example? I don't know if there's an average, but just as an example of the policy holder for a typical policy. I know it can be a male and female, but what's the age and what's the typical medical condition
Yeah, good question. Typically, we're looking at people usually 75 and older, a lot of times over 80, maybe even over 85, as some of our policies are. They're typically going to have several health issues, maybe a history of cancer or cardiac issues, type 2 diabetes. It's all over the board. A lot of times people have multiple life expectancies. Sometimes I'll be talking with someone who thinks they might be an interested investor, but then they get to thinking and they say, well, gee, my grandfather's still alive and he's 96. Well, your grandfather's probably not, 5 foot tall and 250 pounds and whatever, right? It's something I call anecdote bias. In other words, we all know someone that's, fit and healthy and lived a long, long time, but that doesn't mean everybody is going to have that happen. And so, on the other end, though, nobody knows when someone's going to pass away. So all we can do is try to mitigate that, use the professional actuarial life expectancy laboratories to get the best information we can on that. But, you're looking at typically over 75, multiple comorbidities and multiple health issues, and probably a 3 to 8 year life expectancy is a pretty average range.
I see. And if I understand this correctly, Brian, you acquire these policies not from the policy owners directly, but basically you're acquiring it on the secondary market. Those people, they they were facing a choice: either let the policy lapse or just surrender it for the cash value, but they chose to sell it on the secondary market, which was the most beneficial to them. Correct?
Correct. Yeah. The reason they sold it, it's not always, they needed money desperately. Sometimes it's, their children did well and they don't need to, maybe they did well. They don't need to make them millions of dollars richer. These are some large policies that we're acquiring. We have a $2.8 million policy. We have a handful of $5 million policies. We even have a $10 million policy. So these are not always people that, hit hard times and needed the money. Sometimes it is, but sometimes, the motivations for selling a policy, it boils down to three things. Either they don't want it anymore, don't need it anymore, or can't afford it anymore. And they've sold it into the secondary market. The reason, that we don't go out and look for policies to buy from individuals is, like I mentioned earlier, there's strict criteria. We need the ability typically, and again, I'm not going to say it can't ever happen, but typically we want to sift through a lot of policies to select one that we want to acquire. If we went out and, we'd need a whole division, army looking at people's policies. But, if you watch CNBC, you see commercials. There's a company called Coventry Direct. They advertise to seniors on television almost every day that they're looking to buy policies. And, that's a whole business that's out there. Again, most people aren't aware of it, but for us to go do that, one at a time, we'd have to, it would be so time consuming that it's much easier and better and efficient and better for our investors if we can find and pick out policies from a large selection of them.
All right, thank you. And last question from Summer, from the liquidity standpoint, can you get a loan on your capital from a trust or where the bank is?
That is something I wouldn't want to comment on. I suppose if someone, could estimate the value, but you really shouldn't tie up funds that you can't wait for the maturities on, and you need to have, other liquidity that you could pay premium calls if you get them. So if that's a concern, I would say, maybe invest a smaller portion of your net worth so that you don't have to necessarily worry about that.
I think, Brian, what the question was is that when the investor makes the investment, that they're actually becoming a part of a trust with other investors, correct? That is, the trust owns the policy, correct?
The trust owns the policy, and you own a beneficial interest in that trust.
Okay, so
so whether or not you could get a loan against that or not is I do not know.
Well,
if that's the question.
Yeah, I think the question was, will the trust provide a loan against that? So I think the answer is no.
No, yeah, I think that's.
Yeah, those are again, that's not something that is liquid. You have to wait until the maturity of the investment. So that's why I think, Brian, you mentioned that in the beginning, but there is a certain criteria that you have to use. You cannot invest more than a certain amount of your net worth unless you are accredited investor. So it's 10%, right, Brian?
Correct.
Yeah, so it's for that reason. And yes, if you do need funds in a short-term period of time, then you should not be tying this up. This is a great investment for a retirement account. It can be also a good investment for your non-qualified funds, but only those funds that you don't need in the immediate future. Well, we're going to conclude at this. Thank you so much, Brian, for joining us. And a question that few of you asked, so if I want to get more information, look at the specifics, specific investments, what's next? Well, the next is for you to schedule a consultation, and I'm going to go ahead and put that on your screen. Basically, once we end this, you're going to be taken directly to the online calendar where you can actually schedule a consultation when you and I can chat about the specifics, and we can go from there. Thanks again for joining us. Brian, thank you, and thank you, everybody.
Thank you.